It's time we welcome our market master for the day, Andrew Holland, the CEO of Ambit Investment Advisors. Good morning, Andrew. You're joining at a very jubilant time for the markets. What would you do now? Would you continue to be a buyer?
Yeah, I mean, it's great for the markets. It's difficult to stand here and kind of, be cautious because the markets just keep defying anything you say. But I am cautious, and I've been cautious for some time, and it's just, proving to the liquidity is proving too much at the moment to be cautious. And what I take from what happened on Friday was that obviously the US will continue to grow ahead. And she's just yelling, that is just being extra cautious in terms of when the interest rate hike will come, but it's coming, that's for sure. And the European Union is just falling apart. So you're going to get the move towards the dollar. You could even see bond yields in the US drift down again as there's a flight to safety there. And whilst the oil price is benefiting India at the moment, it's hurting Russia, and I just wonder what the next move by Russia will be, in the winter months, which obviously, if they were to stop the gas to Europe, would have a bigger impact. So I don't think we're out of the woods yet, but liquidity is so strong, Lata, that you just can't fight it at the moment.
Andrew, hi, good morning. Good to see you, and as always. In fact, you have been expressing your caution very well on Twitter too. I was reading a tweet that you put out the other day where you said that, FIIs could take money off the table if they smell a currency crisis. Do you think there is a currency crisis coming? I mean, the dollar index has been hitting new highs.
Yeah, I mean, I think if anything, it's the euro which I'm kind of worried about at the moment. We're seeing it at 132. If it goes under 130, you could see, a lot of currency turmoil again, which would obviously have an impact for emerging markets. So that's, that was in conjunction with really the fact that, we haven't seen anything change in India. There hasn't been that big bang reform we were hoping for, or the market was expecting initially. So, as nothing moves on the ground and the insurance bill has been moved to, the next winter session, we might just get a bit of fatigue in the markets, and, anything globally which is more negative, would have an impact for India as well. So just a bit worried on that front. It's being ignored, as I said, because liquidity is so strong at the moment.
Yes, fair point. You can't argue against money when it's coming. But Andrew, maybe there is a basis to the money coming in. Crude at 100 was not factored in by any of the analysts or the economists. That makes the macros very positive for India. Current account deficit is not even a worry. It wasn't even when crude was at 114. But now it's almost a non-issue. And fiscal deficit looks way more manageable. 4.1 was seen as bravado talk, but now it looks like almost a cakewalk. So don't macro adjustments prove a tailwind now?
Yeah, I mean, obviously that would help the kind of rating agencies keep away from India for some time, and keeps the stability there for some reforms to come through. But we haven't seen that, and that's what my concern is that you need to see, for India Inc. to move forward. We have belief at the moment, but belief to go back to hope and then despair, doesn't take very much. So I think we need to see something happen on the ground to attract foreign direct investment into India, because that's going to be the key. And we just really haven't seen that. So, the valuations that you see in the market at the moment are pretty kind of reasonable. So, pushing ahead from here is going to be difficult without some policy moves. But obviously, if the fiscal deficit is under control and the oil price remains low, which is a big if, at the lower levels that we see today, then obviously we'll start thinking about when interest rates, may be able to start falling in India. So the financial gearing aspect of corporate earnings, start to kick in. So that's, to my mind, still a 2015 play. We're still playing the operational gearing here, because we think that's where you're going to get the bigger earnings momentum going forward.
By the way, big gains coming in on the markets right now, and specifically in some of the PSU banks. Remember, names like SBI and PNB had already gone up about 7 to 8% last week, and these are names that are inching higher. SBI is already up about 2% this morning, and PNB as well, now inching closer to the 1,000 mark for PNB. So big moves coming in over there. Andrew, if you could just, explain your caution to us in terms of what sectors one should either be taking profits out of or avoiding right now. What would they be?
Yeah, I'm not necessarily, when I say caution, it's really for, some volatility globally which will hit India and bring our markets down. So there's no one particular sector. I just want to remind you that I am still bullish about the market over a 3-year period. So what we're doing is really looking at how to play the domestic India story, because this is what it is. And one of the themes that we've identified is the domestic supply theme across many sectors. So it's multi-sector, multi-company. It doesn't matter what market cap. And this is where we feel you're going to get operational gearing as well, which will push the earnings of those companies. So you would see a very significant increase in both earnings and the share prices going forward. So I'm less worried about the index levels. I'm not really trying to play the index. I think there's more value on the domestic supply theme going forward than there is just looking at the index.
Okay. Well, Andrew, I take your point that there have been no big bang reforms, but maybe that's the point, that is the game that we are missing. All through UPA we had this big bang reform desire, and sometimes an effort to even announce them, like FDI in retail, really didn't come to much and won't impact much an economy like India. Maybe here there are piecemeal things happening, like Rajasthan state amending the Factories Act or tweaking the Land Acquisition Act. Elsewhere, the government perhaps coming in with less visits from labour inspectors, less of that Inspector Raj. Maybe we will get to see something of that showcased when we believe the Prime Minister and the Cabinet showcase their 100-day achievements. Maybe it is these quiet achievements that are enthusing the market. Big bang reform announcements don't get you anywhere.
No, when I talk about big bang reforms, I'm not talking about anything which is, like an FDI in retail or changing the labour laws overnight. Those will take significant time, as GST will do as well. We've never been saying that the economy is going to kind of have a V-shaped recovery. We're looking at 5.5% this year and 7% the year after. So we were looking at modest gains in the economy as it bottomed out at the back end of last year. But what I would say, Lester, is this: is that when you make an Independent Day speech and say, come and manufacture in India, we don't care if you're going to sell here or sell elsewhere, then you've got to showcase something, right? And if you haven't, where's a big company coming in and saying, guess what, we hold these, we've got our land acquisition, we've got our whatever linkages, all the approvals in place. Where is that? Who's going to be rushing to do this? So, when I say big bang reform, it could be just something that's showing the way forward. If you ask any corporate, and please do next time you have your corporates, if anything's changed on the ground for them, the answer is with a big no.
No, that's fair enough.
Including Inspector Raj.
We are going to get one of the infrastructure guys shortly in. We'll certainly remember to ask him that.
And in this quarterly performance as well, I mean, we did not see any pickup on the ground whatsoever,
so
specifically for some of these infra companies. But we have a query that's come in on our Money Control message board, so I'm going to just throw that to you. Hemant Pansare has written to us from Mumbai, and he wants to know which pharma or oil-related stocks would be a good buying opportunity currently. I know you keep away from recommending stocks, but if you could just elaborate on these two sectors.
Yeah, well, the pharma sector is, the only play in town for us is Sun Pharma. So I don't really want to be in defences, but if I have to be, then Sun Pharma is the only pharmaceutical stock I want to be in at the moment. As regards the oil and gas sector, and I'll go back to my domestic supply theme. If we're going to build 15,000 kilometres of gas pipes over the next 3 to 5 years, spending $25 billion, I want to find the gas pipe supplier, not the owner, because that's where you're going to get this huge increase in orders, and obviously then manufacturing capacity will be increased, and then you'll have operational gearing, and there's only a few companies who can do that in India, so without naming them, they are there.
Okay. Well, Andrew, your caution is well received when you say that we haven't yet anyone talking about expansions yet. But do you see any major ambushes for the market itself? We had, I think, Movac speaking to us earlier in the morning, and he was pointing out that even if the Fed were to hike rates, Fed rate hiking cycles have actually coincided with equity markets doing well. At least in 2003 they did. So even they are not expecting a major setback, even if that rate hike were to be, say, in June or September or whenever that is. What do you see as a major impediment to this equity flow, to this liquidity flow?
See, Lester, what I worry about is that we've had so many years of unprecedented liquidity in the market that when we get a rate rise, and you can go over the history and say that this is what happened previously. But this time around, I don't know what the unintended consequences of this is. We saw some problems in Europe, and you saw one of the banks very quickly have a huge amount of debt problems and loan problems. So I'm really not sure what it all means. So the cycle's been so prolonged. It's not the normal economic cycle that you would normally go through, where you see interest rates rising and that scenario playing out. So I'm a little bit kind of more wary about how it might play out, rather than just saying we go back to what's happened previously, because previously this has never happened. So I'm a little bit more kind of cautious on than the former speaker in terms of what the unintended consequences would be. I don't think we know.
Okay. We were also speaking with Motilal Oswal today, just a while back, and they were pointing out that India dedicated funds are yet to see meaningful inflows. So there's still a lot of scope for money to come in. Are you getting a sense as well that the FII investments could pick up in the next, say, 6 to 12 months?
Yeah, I mean, that would be the hope, but I don't think India as yet, India dedicated funds have received any meaningful inflows, and I think the jury's still out. I think going back to what I was saying, in terms of whilst we're seeing fund flows into India, that's partly because of a lot of the multi-asset strategies or BRIC funds where allocation to India has been an easy one to do. Now China's competing, I think, for money. It's very undervalued compared to India. So if people feel that China's now starting to pick up and can make some money for the first time in 3 to 5 years, then you could see more incremental flow there. So I'm not so sure you're going to get a wall of money, which people would hope for. But obviously you've got Prime Minister Modi going off to Japan and US and a few other places, so that might stimulate some interest. I hope it's more from foreign direct investment than it is from FII investment, to be honest.
Fair point, Andrew. Well, just what is the earnings growth you are working with for FY 15 and 16, and do you see any upgrades at all? Did you see any in after the last earnings?
Not really. Incrementally, a little bit here and there. If anything, I think the earnings season was a little bit disappointing towards the end, as it probably always is. But what we're looking for is at least 15 to 20% earnings growth for this year, and an acceleration the year after as GDP moves towards 7%. We're very bullish on earnings, Lata. I mean, I keep talking about operational gearing, and it is huge in India. So before you start, thinking about capex cycle for Indian corporates, they first of all have to get their capacity utilization up from 70% onwards towards 80, 85 before you can start seeing that incremental flow towards capex by Indian companies. So there's a lot of earnings growth to come through in the next few years. And I keep going back. It's similar to 2003 to 2006. GDP growth, huge earnings growth, and a re-rating. But it's not all going to be the index. Fair
point. Thank you very much, Andrew, for joining us and injecting in that dose of caution which is always needed, especially when markets are at all-time highs.